Okay, perfect. Good morning. We are now live. I'm out in Kelowna, and I don't know if you can tell, but it is a beautiful day. A little too windy to go water skiing, so I think I get a little more time to shoot this video and play with the kids once they wake up. So I will have to be somewhat efficient because on vacation they tend to wake up a little bit earlier. So for the next 2 weeks we'll be out here, which means I will be shooting from this beautiful location overlooking the water, and yeah, it should be pretty fun. So anyways, I thought today what I would do is I seem to be getting this question more frequently lately, and that is well, I'll tell you a quick story first. I think it was last week, Monday or Tuesday, I had a great conversation with a gentleman who lives in Toronto, and he's a successful business owner. And he was asking me about commercial real estate investing. He was very interested in it, and his initial comment was, the Toronto market is extremely hot, and I'd rather look elsewhere to start investing my money. And I understand that perspective very well. And the reason I understand that is because I have fallen for the same trap, which is I start thinking the grass is greener and looking at other cities. I mean, it's not to say that for me, I'm not going to, I won't stop because I've been investing and I've got relationships in these other cities. But what I will say is that, especially if you're just starting out, the key in my mind, especially when you're looking for that kind of what I call your unfair investing advantage, is to be investing in cities that you understand, that you have connections and relationships in. And so my advice to this business owner, and we didn't get into the specifics because that wasn't what best served him on that initial call that we had, but I've got two coaching clients that I'm working with this week that we're going to go through and determine their investing criteria. And so what I thought I would do is I would share at least some of that with you here today. And that it's really kind of the 7-step framework for evaluating and choosing the best markets and cities to invest in. So that's what I want to talk about, and that's what we're going to go over today. And I'll tell you really what I mean by this, and that is, like, the goal in my mind after this training is for you to be able to identify the market gaps. And what I mean by gaps is in every market, and I don't care what city you live in. Obviously, if you're in a really small town, personally, then you may want to expand and explore out beyond that. But you know what? If I'm not going to get into the specifics, it's just a personal philosophy for me that because my exit strategy is so important, I generally shy away from towns that are too small. So I'm just going to leave it at that. But if you're in a city that's big enough to warrant investing in commercial real estate, then what identifying the gaps in your marketplace is going to do is, number one, it's going to give you confidence. And it's going to give you confidence in, first, the city that you live in. Number two, the asset class that you want to put your money into. Because the reality is, right now in Calgary, where I live, or in Toronto, where this gentleman lived, or it could be Seattle, it could be Houston, Dallas, it really doesn't matter. There's going to be typically asset classes that are in favor, and right now multifamily is pretty hot. Actually, in Calgary, it's not very hot because, frankly, there's a lot of supply, and the demand has really come off. But every market's going to be different, and you really need to understand that. So are you looking at multifamily, retail, office, industrial, mobile home parks, all those types of assets? And then understanding why your marketplace is the city, if you will, is the city that you want to invest in. And that really comes down to understand the macro fundamentals of your market, which we're going to get into. So what I'm going to do is I'm going to give you the 7 steps, but because it would take far too long to get into all 7, I'm going to cover the first 2 in real detail today. Okay, so the 7 kind of fundamentals to determining where you should be investing. And I really want to back up a minute here. These are just my beliefs and philosophies that I follow myself. So this is how I invest my money. This is how I invest my investors' money. So I'm not telling you that this is the way that you should invest. I'm just suggesting that if you're starting and you have no framework or foundation to invest, then you may want to consider this. Okay, so that's really what I want to just kind of be clear. All my advice is advice that I would give my mom, my dad, my best friends. It really doesn't matter. So this is like I said, this is just how I invest. Okay, so back to the training here. The 7 steps. Number 1 is choosing your city. Number 2 is understanding the macro market fundamentals. So the first 2 are really on research. Number 3 is interpreting the data, understanding why that information is important. Number 4 is recording that information and data so that you can refer to it and you can start to see trends. That's really important, because just having a bunch of information and data, and I mean, I'll give you an example. This here is the book that I use. This is just one. The other book is underneath the laptop here that's propped up, on how I coach my clients. And so, but just having this paper is meaningless if I don't understand why it's important to be able to articulate that to someone. So when you're looking at all this data, what you're looking for, generally speaking, are trends, right? So when I tell you population growth, that's probably fairly evident, right? But supply and demand, is it a good thing that there's a lot of permits being pulled right now to construct new multifamily? Maybe that's a healthy sign. However, it might also be, oh, the sun's coming in there. It might also mean that if the demand is not keeping up with supply, that you're going to have a market that is oversaturated, and that's going to put downwards pressure. So you just want to keep those kind of considerations in mind. Okay, so where were we? We did number 1, choose your city. Number 2, the macro market fundamentals. Number 3, interpret the data. Number 4, you want to record the data. Number 5, you want to decide on the city, the asset class, and the location. Number 6, you really want to become a local expert. And what I mean by this is, generally speaking, I like to advise my clients to have at least 100 live deals, or deals that have closed in the last, call it 12 months, so that what that gives you is, number 1, a database, so you understand all the nuances of each one of those deals. And so I've got, I think, 23 investing criteria that I look at on each deal, and you're not going to get all of it all the time, but that's not the point, because when you've looked at 100, let's say you've looked at 100 apartment buildings or 100 retail strip centers or 100 office buildings, when you go have a conversation with a broker, with a lender, with a possible investor, with a seller, you're going to go in there with so much background and research and intel that it's going to give you that confidence to be able to negotiate and know whether or not you've got a good deal. I mean, my brother sells residential real estate, and he tells me now he understands the market like unbelievable. I mean, he's just a master at it. But new real estate agents in his office will go out, and the buyers, in many cases, because they've been researching the market and they've looked at 100 plus houses, and they've probably went into 50 open houses, they know the homes and the comps better than the realtor does. So what happens in those situations is, now all of a sudden the buyer has more control. And so what I'm trying to do in a similar fashion, and I just came up with this analogy, so I hope it works, is that as an investor, I want you to be the one that has more intel and knowledge. It's unlikely you're going to have more intel than, say, the commercial broker, because a commercial broker, if they've been doing it a long time, they've got it dialed in. But you might know more than the seller, and you sure as hell better know more than any investors that you're raising money from. So that's number 6. And then number 7 is really kind of compiling all that information in, and then writing your summary. And what I mean by that is, you're going to have kind of an analysis of the city that you want to invest in, the asset class that you like, why you like it, and then you're going to kind of take all the macro fundamentals that you took in number 2 and number 3, and you're going to the word I guess would be like synthesize. You're going to basically like compile them into written format so that you can share it with someone, and that's really going to help you, especially when you're raising money, either debt or equity. Okay, so those are the 7 steps. Now, what I want to focus on is, like I said, number 1 and number 2. Number 1 is choosing the city, and then number 2 are the macro fundamentals. When you're choosing your city, there's really 2 options you have. You can invest in the city you live in, or you can invest in other cities. And man, that sun is just so bright. Like, I don't know if it's going to be any better like this or not. Yeah, maybe that's better, hey? Okay, let's try that. It's just really awkward how to having to sit backwards in the chair so that you can kind of still see, but we'll give it a shot. The reason I like starting with the city that you live in is, I think I've touched on it, is you're going to have the connections, you're going to have the relationships, and you're going to have a local advantage, especially when you're managing a property, because this really is a business, right? And so if you are investing in a city too far away that is difficult to get to, I'm going to say more than an hour drive, maybe 90-minute drive, depends on how tolerant you are. For me, 90 minutes, I know I'm not getting there every week. It's just a reality. So if you can invest in a city that is closer to home, you're going to be able to manage the people, because let's face it, in commercial real estate, you're going to have a property manager 9 times out of 10 that's going to be taking care of your tenants, and you want to be able to check in on them as frequently as possible. So that's why I suggest choosing a city that you live in. However, if you go through all the market fundamentals and you realize that the city you're in isn't the one that you want to be in, then you can use the exact same tools to identify, call it other cities that you know, and other cities that you maybe want to know. And other cities you would know is maybe you went to school there, maybe you live there, maybe you've got good friends, maybe it's close by. And then other cities would be, say, cities that you really want to invest in because you think that the market fundamentals are strong. Okay, so I don't want to get into that, because I think 9 times out of 10 you're going to be able to focus on the city that you live in, because there's deals in every market. Okay, the tools to research your city, I've actually I thought about giving them out, because I'll just show you. So here, but you can see it, it's really hard. So I've got research tools just in Canada. You can go to Marcus Millichap, you can go to CB Richard Ellis, you can go to Zillow, you can go to PwC, CMHC, there's a website, IRR.com, but that's not very helpful, especially if you're driving, and I just rattled through those. So if you want, go to clubsyndication.com, I don't know if it's / or / scorecard, and you can get the specifics on the actual tools that I use. Okay, so that is going to really help you in identifying. The research tools that you're going to get there are tremendous. Okay, now, but before I go on to number 2, which is the macro fundamentals, I think it's important to just kind of solidify the 3 core truths on investing in commercial real estate, and that is, number 1, you want to buy on cash flow today. So we're not focused on buying for appreciation, although you may force appreciation. And what I mean by forcing appreciation is you buy a property. Actually, I was just having this conversation with a client of mine, and he wanted to understand what I meant by forced appreciation. Forced appreciation is when, let's say, you buy an apartment building and you put a washer and dryer in. That's always the easiest one, right? So you have now added value. A renter is going to see that value, and they will pay more to be able to rent in that building. Okay, that's forced appreciation. When you are buying on, say, the vendor's assumptions, where they say, well, rents are $1,000 a month, we're only getting $800. You can buy this and you can get $200 extra a month. Now that may be true, but the reality is there's going to be some pain that goes along with that. And so you're not buying on that. You're buying on, typically, on today's cash flow, the $800 a month. Now, there's a good reason why they're not getting that $200 delta, the difference between the two. Obviously, that's a judgment call. So I think that explains that. Number two is you want to secure long-term debt. I secure long-term debt generally once I have a stabilized property. Okay, that is all I want to say on that, because that is a very it's a more complex topic because I do developments and I do kind of significant distressed rehabs on commercial properties, which means I generally will go in with either all cash or bridge mezz debt, meaning I will not put long-term debt on because I know I'm going to refinance out. Number three is raising sufficient capital, so and having reserves, and I think that probably is enough of an explanation, but you really don't want to run out of cash on a commercial real estate deal. So making sure that you've got proper equity and reserves on every deal is just so critical. And a lot of new investors try to really skinny it up because they don't want to raise too much equity and have call it a burn rate, or they don't want to have to pay out too much money at the end of the day. And that, unfortunately, if you lose the whole property because you're undercapitalized, then you get nothing. So we'll just leave it at that. Okay, so now we're on to number two. So what research are you going to be doing? And this is really, like I said, an exercise that I go deep on with my clients. And I'll tell you why, because I do get some pushback, because frankly, they just want me to tell them what to do. And I can tell them what to do, but if they don't have the confidence, the clarity, and the competence, then when they go into the market and start talking to brokers or agents or whoever it happens to be, then they're really going to be at the they're going to get pulled in lots of different directions, and they're just, unfortunately, they're probably going to fall victim to buying the wrong property, because they're going to end up with a crap property. Because in commercial real estate, especially in commercial real estate, there's kind of a saying that the man with the money gets, there's a man with money and a man with experience. The man with experience gets the money, and the man with the money gets experience. I think that's how it goes. And so what I'm trying to do is give you that experience up front, because if you start with money, then I want you to end up with more money, not less. Okay. So we've already talked about that. So here are the macro fundamentals that I really want every investor, especially you, to really kind of ingrain when you like understand really well when you're investing in your market. You want to know the jobs and unemployment. So that's number one. Number two, you want to look for GDP growth, and GDP is kind of like output in that city or province that or state that you happen to be living in. Number three, I'm looking at population growth. Number four, I'm looking at job diversity. So in Calgary, for example, we're heavily oil and gas centric. So when oil went from 110 a barrel down to whatever it was, $27 or $28 a barrel, jobs were lost. And because we're like, call it a one-horse town, now you see office towers in downtown Calgary that are 27, 28% vacant. So you got to understand that. Now, that doesn't mean that industrial is still doing well, because there is distribution centers, and it's not that oil's come back, and so there is job growth, but just understanding that job diversity is really important. Number five, is supply and demand. So what I want to focus on here is how much new product is coming online, and so you're going to likely find that information in a few different places, and each city is going to be different, but typically you're going to find those on the city's website, or you can find them on census or statistics. I use CMHC in Canada. Number six is the political environment. This is kind of an intangible that not a lot of people look at, but I think more and more these days you're starting to see how important politics plays a role in wherever you're investing, whether it's at a municipal, state or province or federal level. Number seven is financing and how readily that money is available from the banks. So that's going to come from the type of lenders that you're going to be dealing with. And then number eight is what I call miscellaneous, and that is, are you in a landlord-friendly state or province? Is there rent controls? What's the city ranked in terms of its other peers, and how affordable is it to live there? Okay, so those are kind of the factors that you're going to want to research and then look for the trends. The next one, now the resources for that are going to be your Chamber of Commerce, the Economic Development Office. Those are amazing for giving kind of really detailed information. I would go on the city's website. I'd look at census bureaus. I'd look at CMHC, FHA, Freddie or Fannie Mac, Freddie or Fannie Mac, Fannie Mae, sorry. You're looking at big accounting firms. You're going to be looking at the banks, and so that, like I said, that's going to be in clubsyndication.com scorecard. You're going to be able to get more of those resources. And just to kind of recap, because we're coming up on the end here, when you take the time to truly understand the economic drivers in your city, like I said, the biggest benefit that's going to do is give you the confidence to invest. And I can't stress that enough, because so many investors, it's like they've got their foot in the gas and then the other foot on the brake, and like they just can't get going. And some of it is mindset, but like I said, I think a lot of the mindset comes from not having that true comfort to say that is a good property. Because the only way to know that that is a great property is to know the other 100 that you looked at, and you can say, wow, I wish I would have invested there, or man, I'm glad I didn't invest there. But that only comes from really understanding it. Now, some investors are going to say, you know what, I don't have time to do that, Shane. And like that gentleman in Toronto, he just said, Shane, I'd rather invest with you. That's fine. But that doesn't mean I still have to do that work. And then he's going to get the summary and he still needs to interpret it. But there's a lot of people that want to be able to do what it is that I do, which is to invest in commercial real estate. And there's just no shortcut to get there. I wish there was. Actually, no, I don't wish there was, because if there was, then everyone would be doing it. And the reality is very few, because how many people are going to take the time to, I mean, these are just my summary cards, but I showed you my binder earlier of all the research that goes into finding a commercial property. Okay, so I'll give you a quick recap and then we'll sign off for today. So number one is obviously choosing the city that you live in first to start, I think is just so critical. Number two is really understanding and researching it, looking at those key reports. And then the number three is the 8 macro fundamentals: job growth or unemployment, supply, demand, GDP, population, government policy. And probably the best way to get those research tools, if you will, is to go to clubsyndication.com / whatever the hell it is, scorecard, and you can just download it free. So I really appreciate you taking the time today to listen in. And yeah, if you enjoy these episodes, obviously this is on Facebook Live, but it will be posted on my podcast. If you like the podcast, appreciate review, and hopefully it's a 5-star. And I'll just kind of keep putting out content that I think is really what I'm doing is I'm kind of taking the feedback from my audience, and I'm getting more and more emails and questions. And so what I'm trying to do is say, okay, you know what? I've got 5 questions last week on this specific topic. I'm going to create a video on it. Okay. So obviously I do these longer shows, and then I try to do kind of 4 or 5 shorter ones throughout the week. And so if something comes up and I can answer it quickly, I'll do that. Otherwise, I will continue with the long format on Tuesdays. And that's it for today. Okay, hope you enjoyed, and we'll see you next week. Bye for now.